Hi, everybody. Here we are again. Last class period, we kind of wrapped up chapter 10. Seems like we were touching on a lot of little subjects in regards to fixed assets and natural resources. I had you do some reading on intangible assets. So the first thing we're going to do today, we're going to go through the homework that I assigned. That'll pretty much take us, that's pretty much the end of chapter 10. And then we will start on chapter 11. Okay? So let's go ahead and dive right in. The first one let's go over is Quick Study 10.5. Quick Study 10.5. And this one had to do with revising depreciation. And as we stated last time, depreciation is based on a number of different there's two different estimates we use in depreciation. We estimate the salvage value, we estimate the useful life, and if something comes to light during the life of an asset, whereas we realize that maybe our original estimates were not as accurate as they should have been, we can revise it, and that's what we'll do. That's what we'll do with this one. Okay. All right. Refer to the facts in Quick Study 10.3. We'll look back at that. Assume that Deidre Band uses straight-line depreciation, but realizes at the start of the second year, due to concert bookings beyond expectations, the equipment will last only a total of 3 years. Salvage value remains unchanged. Compute the revised depreciation for both the second and the third year. Okay? All right, we got to take a look back at Quick Study 10.3. Look at that a little bit. Looks like the cost was $32,500. They estimated originally 4 years. And it looks like the salvage value was $2,500. Is that right? Okay. So let's see how we did this. Okay. First of all, we got to figure out how much they depreciated that first year. Okay. And so what they originally did the first year was they took the cost of $32,500 minus the salvage value of $2,500, and they took it over 4 years. Whoops, I need to back that up a little bit, don't I? Okay. So what does that equal? $7,500 a year? Okay. Now, we've only depreciated 1 year, haven't we? So we depreciated $7,500 in 1 year. Okay. Now we're at the beginning of year 2, and we're going to change some estimates, or at least one of them. Okay. So the first thing we have to do is figure out, okay, what is the book value at the date of change? Well, the book value at the date of change is the cost minus the accumulated depreciation. I think I'm going to switch over now to our printouts here. Okay, so this is the book value at the date of change. $25,000, the cost of $32,500 minus the amount of depreciation that we've taken. In this case, it's only 1 year, and that gives us our book value of $25,000. Okay. Then we subtract out the revised salvage value if it's been revised, and I think in this case it has not been revised. Okay. So that would be our numerator in that equation. Okay. The book value at the point of revision minus the salvage value. And then we divide that by the remaining years of life on this. Okay. Now we changed it to a total of 3 years in total. But 1 year has gone by, right? So there's only 2 years left. So what we're going to do is we're going to depreciate $11,250 for year 2 and $11,250 for year 3. We're not going to go back and change prior journal entries. We're not going to go back and restate financial statements. We're not going to do anything about that depreciation entry we made in year 1. Just going to leave it as it is. We're just going to depreciate a different amount than what we originally thought for year 2 and for year 3. Okay? Make sense? Cool? All right. Okay, let's jump on to the next one then, which is, oh, we're kind of jumping around here. That's okay. I believe it was 10.9. Was that the next one? 10.7? Okay, let's do 10.7. Okay, you're right. Sorry about that. Quick study 10.7. Lauren, did you have a question?
I wasn't looking, but I didn't understand how you got 11,250 for the end of that, or why you added 2 years. Maybe I read it wrong.
Well, yeah, take a look at it. The 11,250 is the 22.5, which is the book value at the point of revision minus the salvage value, divided by how many years left we have of this asset that we think will use it. Okay. Take a look back at that original equation on the slides, in the PowerPoint slides, where we talked about revising depreciation. You'll see that. You might see it just a little bit different format. Not different numbers, but they're going to probably have like book value at date of change minus estimated salvage value divided by number of years remaining. Okay?
All right.
All right? Okay, so let's go to Quick Study 10.7. Classify the following as either revenue or capital expenditures. Okay? Now we talked about this last period, I believe. Number 1, or letter A, I should say, paid $40,000 cash to replace a compressor on a refrigeration system that extends its useful life. What would that be? That's a capital expenditure. That extends its useful life is the key phrase there. Letter B, paid $200 cash per truck for the cost of their annual tune-ups. Revenue expenditure, that's something that's an ordinary repair, ordinary situation that we presumed would occur when we purchased the asset. Letter C, paid $175 for the monthly cost of replacement filters on an AC system. Another revenue expenditure. So B and C, we would just expense them, right? Maintenance expense or miscellaneous expense or repairs expense. Letter D, completed an addition to an office building for $225,000 cash. That's a capital expenditure. Okay? Number 2 says prepare the journal entries to record transactions for A and D. Okay, now those were the capital expenditures, right? Now, what they want to get at there, and you can see it there at the bottom, is that for the capital expenditures, we're going to be debiting not an expense account, but an asset account, equipment and building. To capitalize something means that you are setting it up as a fixed asset rather than expensing it. And once, of course, you set that up as a fixed asset, you will have to depreciate it accordingly, correct? Okay? So any questions on Quick Study 10.7? Did you guys get that? Okay. Make sure you guys are doing your homework, okay? You at home, same thing. If you're just watching these lectures or coming to these lectures and just copying down the answers, you're depriving yourself of the main way that you learn this stuff, okay? The main way you learn this stuff is not by watching me do it. It's by doing it yourself. You catch yourself in certain errors. That's the way you learn, okay? So you guys need to be doing your homework, okay? All right, let's go to the next one. Quick Study 10.9. Okay, here it talks about natural resources. Quick Study 10.9. Crandon Company acquires an ore mine at a cost of $6.3 million. It incurs additional cost of $500,000 to access the mine. Thus, the total cost of that mine is $6.8 million, correct? And the mine is estimated to hold 1 million tons of ore in total. The estimated value of the land after the ore is removed is $900,000. That's the salvage value. Prepare the journal entry to record the cost of the ore mine. Okay? All right, so let's do that real quick. Now, as I said, the cost of the ore mine will be $6.8 million, because you have to take into account the cost to access that mine. Correct? Okay, so that is the journal entry to record the purchase of that mine. Okay? Then what does it ask us to do? Prepare the year-end adjusting entry if 125,000 tons of ore are mined and sold the first year. Okay? Well, we can do that. First thing we need to do is figure out, now we're not talking about depreciation here, we're talking about a similar concept, but we call it depletion. How much are we going to deplete per unit? We take the total cost of $6.8 million minus the salvage value of $900,000 divided by 1 million tons, which is the total amount of tonnage we think that's in that mine. Thus, we are going to deplete $5.9 per ton. Well, how many tons did we extract? 125,000. So if you take 125,000 times the 5.9, you get 737,500. Okay? All right. All right, any questions on 10.9? It's not depreciation expense, it's depletion expense. It's not accumulated depreciation, it's accumulated depletion. Okay? All right, we're booking through these pretty good. Okay, any questions on that? All right, let's take a look at Quick Study 10.10. And this is in regards to what I wanted you to read about, intangible assets. Okay? Now, intangible assets are assets, but you can't like touch them and feel them like you can a gold mine or a truck or a building or a conveyor belt or a drill press. Okay? And this gives you some example of some things that are intangible assets. We'll talk about them as we go through this. Okay? Okay, Quick Study 10.10. Which of the following are reported as intangible assets? Which are reported as natural resources? Okay? An oil well, what is that? That's a natural resource. Okay? A trademark. Tangible asset. Can you give me an example of a trademark?
Like a logo?
Yeah, like a logo. Yeah, like the Power Cat or the Nike swoosh. Okay? Seen the Nike swoosh? If I wanted to make a pair of shoes and I wanted to maybe put a swoosh on there, or maybe I even tried to be clever and put it upside down, I would get in trouble for that, wouldn't I? Okay? That's a trademark. Okay? The McDonald's M, okay? Morgan, if you started a hamburger place and you wanted to call it Morgan's Hamburgers, and you made the big M on Morgan look like the McDonald's M, you would be getting a nice little letter from the attorneys of McDonald's. You can't do that. As a matter of fact, when I was growing up in Wichita, Kansas, there was a donut shop, and the name of their donut shop was McDonuts. McDonuts. And they got a nice letter from McDonald's that said, you can't do that. Okay? You can't do that. And of course, you know, sometimes it goes to court, and this isn't a law class. But for whatever reason, they changed the name of their donut place. Because what McDonald's said is, we know what you're trying to do. You're trying to go off of our good name, you know, the McDonald's. And, you know, you can't do that. So they changed their name to M Donut, which I always thought was really stupid. And then about 6 months later, they went out of business. Okay? So you have to be careful in those regards. Now, let's say, Brett, let's say your name was Brett McDonald. Let's say that was the name that your family has had for centuries, Brett McDonald. Well, even if you wanted to start a hamburger place and call it McDonald's Restaurant, you might get in trouble, even though that's your name. Okay?
What if it was McDonald's, like
McDonald's, same thing. Doesn't matter. Doesn't matter. Huh?
You can go Max Burgers.
Well, you have to change it enough, and that's a legal question to be on the scope of this class, where the court will rule that you're not infringing on those trademarks. Okay? All right. What about a leasehold? Going back to Quick Study 1010. What is a leasehold? Hello? That is an intangible asset. A leasehold is like, let's say you are leasing let's say you have prepaid or you have paid rent to lease a storefront in like a little shopping mall or something. That's a leasehold, as your book talks about. Okay. What about a gold mine? That would be a natural resource, right? What about a building? You can't touch a building? They actually tricked you on this one. Building is not a natural resource. Building is not an intangible asset. Building is just a regular plant asset. Okay? Boo. And they didn't give you that option, did they? But you know a building is not intangible assets. Can we touch the building? Yeah, we can touch a building. Okay? We talked about buildings back when we were depreciating stuff, right? It's not a natural resource, but it's not an intangible asset. It's neither. It's a plant asset. Okay? But they didn't give you that option, so they're trying to trick you. What about a copyright? That's an intangible asset. Example of a copyright? I don't. There's some. Yeah, I would say it's probably more like works of art or songs, things like that. Okay. Getting copyright on the song. Okay. Phrases or stuff, I'm not sure if that's a trademark or if that's a copyright. A copyright? Copyrights usually apply to pieces of like music and stuff. Like I said, if you take a business law class, you're probably going to delve into these things a little bit more. So I'm not an expert on this. Franchise. What's a franchise? That's an intangible asset. That would be like if you paid a certain amount of money to have a Taco Bell. That's a lot of money, isn't it? But that would be an intangible asset. Your right to hold yourself out as a Taco Bell. And then what about timberland? That's a natural resource. That would be like forest or something like that. Okay? All right. Good. All right. I think that's it for the quick studies, isn't it? Let's move on over to the exercises. And I think the first one I assigned was exercise 10-9. Is that correct? All right, well, let's take a look at exercise 10-9. Okay, this has to do with partial year depreciation. Okay? Exercise 10-9. On April 1 of 2008, Bryson Backhoe Company purchases a trencher for $253,000. Estimated life is 5 years. Estimated salvage value is $25,300. Compute the depreciation expense for year 2009 if they use the straight line method. Okay? All right, well, we can do that. Let's do that. Okay, hold on. They did maybe a little different than what I would do. All right. What'd you get as your answer, guys? What'd you get?
34,155.
Anybody else get that? Okay. I think they made a mistake in the they made a mistake in the answer key. I think and I'll show you what they put. And if I'm reading this wrong or something, you just tell me. Okay? All right. Well, what they have here, this is what they have in their answer key. The straight line depreciation for 2009 would be the cost of $253,000 minus the salvage value of $25,300 divided by the estimated useful life of 5 years. Okay? And that gives you 45,540, correct? Now that's assuming we had it the whole year though, correct? Did we have it the whole year? I don't think we did. How many months did we have it?
They bought it in April 2008. It's asking for 2009.
They are?
Wouldn't that be
Is
a
that the
year and a
deal?
half?
Yeah.
Yep. Wouldn't that be a year and a half?
Yeah. There you go. They didn't make a mistake. Okay? All right. I made a mistake. That's all right. That seems kind of odd that they would ask the question that way. Okay? But that's okay. We're going to solve this a little different way. They are asking for 09. So yes, you are correct. They are correct in the sense that that is how much we depreciate for 09 because we had it for a full year in 09, right? Now, one thing that they didn't ask, which they should have asked, I think would have been a great question to ask, and I'm not sure why they didn't ask it, was how much would depreciation be for 2008? Okay? All right? Take about 60 seconds, if you haven't already, and let's figure out what 2008 depreciation would be. Okay? Roll that snazzy music just for about a minute, and let's figure that out. All right, so what we're going to do for 2008, we know that we take 45,540 if it's a full year, right? How many months did we have it in 08? How many months did we have it?
9.
We had it for 9. We bought it at the beginning of April, so we had April, May, June, July, August, September, October, November, December. That's 9 months, right? So if we take that times 9 over 12, what is that number? Help me out. I can't do that.
155.
34155. Anybody else get that? Okay. So that's how much we would depreciate in 08, which I think they should have asked about. I'll call the author tonight and tell them that I think they should change their book. Okay? Questions? Lauren.
45,540. We got that after depreciating after 5 years.
No, this is the amount that we would depreciate if we had for the years where we have it in use all 12 months of that year. And one example of that sort of a year would be 09. But you got to kind of figure out how much you can depreciate in a full year if you have it, so that on those partial years you can take it times the appropriate fraction of the year that you had.
Okay, so the 45,540 is just for 1 year. How much it would depreciate?
Yes, that's not for all 5 years. That's 45,540 for each of those full years.
Okay.
Okay? All right, questions on that? Okay, let's jump over to Quick Study 10.9. We just did 10.9. Let's do 10.16. Okay? Quick Study 10.16. Sydney Company owns a milling machine that costs $250,000 and has accumulated depreciation of $182. Prepare the journal entry to record the disposal of the milling machine on January the 3 under each of the following independent assumptions. Okay? All right. Now, first of all, this goes back to the 5 steps of disposing an asset, correct? Now, what was the very first of those 5 steps? Do you remember? it was updating depreciation to the date of disposal, correct? Now here we only have 3 days before we dispose of it, correct? So you do not need to depreciate for those 3 days, okay? If it hasn't even been a month, then just consider that thing depreciated up to that time, okay? Now the steps that you go through on this is once you are updated to the date of disposal, then the next step is you remove the asset from the book. Then the next step is you remove the accumulated depreciation from the book. Then the next step is if you received or gave any asset, you record that. And then the fourth step is, does the journal entry balance? If it doesn't, and you have to debit something, it's a loss that you'll debit. And if the credit side needs help, it is a gain that you will credit. Okay? So let's go through these in turn. What if we disposed of this at no value? Well, first of all, one thing that might be helpful to know is what is the book value. Remember, book value is cost minus accumulated depreciation. The book value of the milling machine at the date of disposal is 68. Now we're going to get rid of this thing, right? And we get no, we don't receive any money or any other asset. Okay? So we take the milling machine off the books by crediting it for $250. We take the accumulated depreciation off the books by debiting it, since it's a contra asset with a credit balance. And then there's no cash given or received. So what we have to debit is loss on sale of milling machine for $68,000. Okay? That's the first instance. What about the next instance? What about if we sold the machine for $35,000 cash? Well, then the journal entry would look like this. Again, go through those steps of disposing of an asset that we discussed last class period. Okay? And that's what you're looking at. Now, some people kind of not rationalize, but we received $35,000 for an asset that had a book value of 68. 35 is less than 68 by 33. So that is also how that checks out to what the loss is. Okay? I always kind of approach it more of as a building a journal entry sort of discussion. Okay, what about the third scenario where we sell the machine for $68,000 cash? Now that's exactly the book value, isn't it? So in that case, there's no asset or there's no loss or gain that is recognized, because that fifth step, the journal entry was already balanced, wasn't it? So that would be the journal entry in that instance. Okay? And then in the final instance, we sold it for an amount that was above the book value. We sold it for $80,000 cash, which is $12,000 more than the book value. And I believe that's how much gain that was recognized. Oops, I need to move that up a little bit, don't I? Okay? Once again, follow the steps. I kind of like these sort of questions, though, because they incorporate a lot of different fixed asset concepts into them. Okay? All right. Does this make sense? Any questions on 1016? On any of those four instances? Okay. All right. Okay, let's move on then if we're good. I think we have what, a few more? Or exercise 1019, amortization of an intangible asset. Let's look at that. Galvano Gallery purchases the copyright on an oil painting for $432,000 on January 1 of 2009. The copyright legally protects its owners for 19 more years. However, the company plans to market and sell prints of the original print for only 15 years. Prepare entries to record the purchase of the copyright and its annual amortization on December 31 of 09. Okay? All right. Well, let's take a look at that. Well, first of all, to record the purchase of the copyright, this goes to your reading that you should have done, is we're just going to debit copyright, which is certainly an intangible asset, and credit cash, since that's the purchase was made in cash, for 432. Okay? All right. Now, with plant assets, we depreciate them. With natural resources, we deplete them. It's called the same. It's the same concept, except it's called depletion for natural resources. For intangible assets, the concept is the same. The spreading out of the expense. It's not called depreciation. It's not called depletion. What is it called? Amortization. So we don't debit depreciation expense or depletion expense. We debit amortization expense. We don't credit accumulated depreciation or accumulated depletion. We credit accumulated amortization. Okay? Now, the way that we figured it in this instance is we took the cost of $432,000 and you divide it by the lesser of those year amounts that they said. Since we're only going to sell the print for 15 years, that's what we amortize it over, 15 years, not the 19 years. Okay? So we are going to amortize $28,800 each year for those 15 years. Okay? Now, accumulated amortization is just like accumulated depreciation, accumulated depletion, in that it is a contra asset with a credit balance. Okay? So it's really pretty much the same, except you don't use the words depreciation or depletion. Cool? That's just what it's called. The spreading out of the expense for an intangible asset is called amortization or amortizing it. Okay? All right. One last one. And this has to do with the ratio that I wanted you to read about. And that was specifically the asset turnover. Okay? All right. Pterodon Company reports net sales of $4.796 million for 08 and $8,758,000 for 09. End of year balances for total assets for 07, 08, and 09 are listed there. Compute their total asset turnover for 08 and 09. And then comment on the efficiency in using its assets if the competitors average a total asset turnover of 3.0. Okay, well, we purchase fixed assets to help us generate revenue, to help us generate sales, right? And the asset turnover ratio, as you should have read about at the end of your chapter, measures the efficiency in doing that, right? Now, total asset turnover, what is the ratio? Remember? Yeah, the equation. It is net sales divided by average total assets, okay? As it talks about on page 410, I believe. So first let's take a look at the calculations of these for 08 and 09. Okay. Let me get that. Okay, there we are. Okay. Okay, check first of all your math. Now don't round that to 2.80 or 2.8 or don't round it to 3. I always like to take these ratios to 2 decimal places. Okay? So for 08 it's 2.82, for 09 it is 4.65. Okay? So which year are they using their assets more efficiently, 08 or 09? '09, right? They're getting more sales for those average assets. Okay? Their competitors have an average of 3.0. So in '09, it looks like they are increasing the effectiveness and efficiency of their assets as compared to their competitors, because they have a higher asset turnover in '09 than their competitors do. Make sense? Okay. Now, I don't like to belabor these ratios at the end of the chapter, but I do like to cover them. Chances are, if you take a finance or managerial accounting class, you'll go over some of these ratios more. Okay. But I at least like to kind of talk on them. They are useful. They're very good. We just don't, unfortunately, we don't have as much time to devote to them as you probably will in a future class. Okay? All right, I think we're done with chapter 10. Okay? Now, we only have a few more minutes, but that's okay. I want to at least start on chapter 11. So grab the PowerPoints that I either emailed to you or however you got those for you folks at home. For everybody here, I handed them out. And let's take a look at chapter 11, the final chapter we're going to cover in this class. And that is on current liabilities. Okay? All right, current liabilities. Let's go to the PowerPoints. What is a liability? Well, a liability is kind of a snazzy way of thinking about it. It's money that we owe right now in the present because of something that happened in the past. And what we're eventually going to have to do is make a future sacrifice, which is usually going to mean cash payment. Okay? That's what a liability is. Okay? Now, there are current liabilities and there are long-term liabilities. Okay? And you can read the differentiation on your PowerPoint between current liabilities and long-term liabilities. Now, I want you to focus on the first half of that definition. Okay? Let me get the pointer out here. I want you to focus mainly on this part of it. Okay? Most of the times you're going to differentiate a current liability or a long-term liability by, is it due within the next year or is it not? Okay? For any liability that's usually due within the next year, it's a current liability. And for those that are due after, that would be a long-term liability. Okay? So coming off the PowerPoints for a second, okay? Brett, if I owe you $100 and I have to pay you in 6 months, that would be a current liability, right? If I owe you $500, Zach, but I don't have to pay you for a couple years, that's a long-term liability. It's just that simple, okay? All right. Now, sometimes there is, going to the PowerPoints, there's some uncertainty in liabilities. Sometimes we're not sure of whom we're going to have to pay, or when we're going to have to pay, or even how much we're going to have to pay. Okay? And I want you to read this chapter in your textbook. One example of this would be if perhaps you are getting sued. Maybe somebody is suing you. So you're not sure if you're going to have to pay that. You're not sure who maybe you're going to have to pay that to. And certainly you're not sure how much you're going to have to pay in regards to that. Well, there's some interesting questions on, well, do you report that liability on your balance sheet at the end of the year or not? I mean, that seems like something that the readers of the financial statements would want to know about. Okay? But there's sometimes uncertainty in liabilities. Now, before we talk more about those, we are going to talk about some known or some determinable liabilities, where we do know who we're going to have to pay. We do know when we're going to have to pay it by, and we do know how much we're going to have to pay. Examples of those would be accounts payable. We've talked about that before. Sales tax payable, okay? Sales tax payable is a known liability. Unearned revenues we've discussed before. Any sort of short-term notes payable. Payroll liabilities, okay? Or multi-period known liabilities. Okay? Let's talk about some of these in turn. Let's talk about sales tax payable. Okay, you all know about sales tax, right? You know if you go to Best Buy and you know that if you're going to buy a DVD for $20, list price, that you're going to end up giving Best Buy more than $20, aren't you? You have to pay sales tax, okay? And so as retailers, they pretty much act as collection agents for the government in regards to sales tax. That means Best Buy collects some money from you for sales tax that they then have to remit to the government. Okay, now that can be a dangerous thing in the sense that you've got some money that's really not yours, is it? Okay, how would we handle that? Looking at this example, on May 15th of 2007, Max Hardware sold building materials for $7,500. There's a 6% sales tax. So this customer doesn't just give us cash of $7,500. 6% times $7,500, if that's the sales tax rate, is $450, right? So we're going to actually get cash from our customer of the $7,500 plus that sales tax of $450, so a total of $7,950. Okay? But that cash isn't ours, at least $450 of that, right? So we have to set up a liability, a sales tax payable to the government for $450. Okay? What about unearned revenue? Well, we've talked about unearned revenue before. For instance, on May 1 of 2007, if our catering business receives $3,000 for a wedding party that has not yet taken place, well, then we have to go back to our old buddy, the revenue recognition principle, right? We recognize revenue when it is earned. When is it earned? When you have provided the product or the service. In this instance up on the screen, have we provided the product or service? Nope. So we debit cash for $3,000 and we credit unearned revenue, which is, what is unearned revenue? It's not a revenue, but it is a liability. That's why it's in the chapter on liabilities. Okay? Because we either owe them their money back or we owe them a nice catering for their wedding. So that is the journal entry we make right there. Okay? And then, of course, when you have that party, when you have that wedding on July 12th and everybody has a great time, you have now provided that product or service. So you can debit or decrease unearned revenue, and you can move it over into earned revenue. You can book it. You've provided what you were supposed to. Okay? Make sense? All right. Let me see here. I'm looking ahead a little bit. I don't think we're going to have time to go through the next section. Okay? So what I would like you to do is, for homework, let's go ahead and do Quick Study 11.2 and Quick Study 11.3. Let's see if there's anything else I want you to do. And I also want you to do exercise 11.1. Okay? So I'll go ahead and write this up and put it on the screen so there'll be no confusion. And that would be right here. Hey, we only have 2 more class periods left, right? Might be a good time to start getting together and thinking about what you want to give me as a class gift. Okay? Always takes a few days to collect money. Okay? Just kidding. Whatever. Okay? I'm just kidding you. All right. Have a good one, guys. We'll see you next time. But do those 3 homework problems.